G'day everyone, welcome to this rundown of global markets. And what an extraordinary start to 2015 we've seen so far with a number of things going on around the world, but I guess the two really big events. The first one has been this crash in the price of oil, and the second one, of course, the decision by the Swiss National Bank that's just having extraordinary consequences. The fallout from both of these events is unpredictable, is going to go on for a long period of time. In fact, I read some analysis the other day that indicated when these sort of massive events occur that often the initial reaction is only relatively minor compared to what's coming, and that it's generally 2, 3, 4 months down the track before you really start to see the impact of those massive moves in markets. So I think we're going to see this as an unfolding story. But I guess the big news of last week is that, as expected, the ECB came out with an absolutely massive monetary stimulus package. And just to put it in perspective, when you look at what the combination of the ECB and what the Bank of Japan is doing at the moment, the amount of stimulus that they're creating is 3 times what the US Fed printed in 2014. So that just gives you an idea of the scale of the money printing. It's quite extraordinary. However, markets took it very positively because it was the stimulus was bigger than what was expected, and so we had a pretty strong rally to finish the end of the week. So let's take a look at some of the numbers. The S&P index ended up by 31 points on the week, and all major global stock markets moved higher, and probably the best performing one was the German DAX. Really was a big move on the DAX, and it's at new all-time highs. And you've really got to ask, where else is this funny stimulus money going to go? It's obviously not going where it's intended to be going from the central banks, and that's into lending to businesses and consumers, because they really just don't want to borrow. And the banks aren't all that keen about lending to a number of areas of the economy that are struggling. And so it's going into assets, it's going into stocks, and it's going into real estate. So it's inflating asset prices, but it's not really doing much else. And that's been the story of what's happened with monetary stimulus in America over the last 3 or 4 years. So it's no surprise we're seeing the rises in the stock market that we are. Higher volatility this year is absolutely going to be a feature of the landscape. I've been talking about that since the middle of last year. It was pretty obvious that as the rubber band got more and more stretched by central bank actions, that volatility was going to pick up, and we're seeing that already. But I still think that stock gains in 2015 could still possibly outstrip what we saw last year. But you're going to have to be very, very targeted about where you go for those returns. As we'll see on the chart in a minute, around about the 1990 level on the S&P 500 is a key support level. So let's have a look at some of those charts now. And just before we start with the S&P, let's just have a look at the German DAX, because that's really interesting. Considering the trouble that Europe is in, it's quite extraordinary to see the German DAX. This is all-time highs. It's never been up there before, and you can see over the last week to 10 days, it's been an extraordinary rise. It is overbought in the short term, so we may see a bit of a pullback, but yeah, just an amazing run in those European indices, or certainly in the German one anyway. Now, let's take a look at the S&P index. And I mentioned that volatility had picked up in the short term, and we'll look at the daily chart in just a minute. But this is the monthly chart. So each one of these candles is a month, and the view that you're looking at here goes back to 1997. So you're looking at about 17, 18 years of price history. And when you look at it on that basis, you can see the unbelievable run we've had since the lows of the GFC, and that really nothing. We had a little bit of a blip down in October to the that's a 12-month moving average, the blue line, but really there hasn't been a change in character yet. So there's really nothing to be taking action about just yet. This is the daily chart. You can see that we're definitely getting more volatility. This sort of action that we saw in October, we'd not seen for several years. You've got to go back to 2011 to see that sort of action. And now we're getting this washing machine kind of action that's occurring because of the oil price, because of the Swiss bank, because of stimulus. All those reasons are causing this extraordinary level of volatility at the moment. But having said all that, you can see the S&P index is really not far off its all-time highs. Now, if we look at this run from the lows in October to the recent highs, then the recent pullback that we've had in mid-December and then again through January has retraced to the first Fibonacci retracement level, and it's held that level so far. Now we've rebounded quickly, we've come back down, we've started to look like we were going to retest that the lows of October, and that really would be the line in the sand for me. If we saw a close below about 1975 on the S&P, then I'd certainly be I'd be concerned about that as a sentiment shift. But at this point in time, that's not happening, and until it does, then I think we just proceed as normal. So the first warning sign would be about 1990, and then I would be concerned about sentiment below 1970. So they're the lines in the sand, if you like. Moving on now to the Australian market, the ASX 200 index was up by about 200 points on the week. It was a big week. It erased all the previous week's losses, and banks were strong, but there's a big story unfolding in gold, and I'll talk about that in just a minute. However, apart from the banks and this bit of a rebound we've seen in the last couple of days, most stocks in Australia are really tracking sideways. I go through many hundreds of charts every week on the Australian market and many hundreds of charts on the American market, and the difference between the best stocks in Australia are trending sideways. The best stocks in America are still trending upwards quite strongly. So it really is a stark difference between the two markets. Turning to commodities, gold gained $57 on the week. It was a strong week, and I can say that the 3-year bear cycle that we've been in is probably finished. Not absolutely definitively. There is still there's still a risk of more downside, but it's probably finished. We are likely in the first leg up in a major new bull market. Now, history shows that on average, you could expect a 33% advance over the first 3 to 6 months for this first leg advance in a bull market. So if this is what we're in, then we can expect an average advance of about 33%. Now, obviously, you get periods when it's less and periods when it's more, but that's the average. Now, I will give you some initial advance warning. I'm going to be running a webinar, and I'm going to be talking about gold and a few other things, and I'm going to be going into more detail on that. So that'll probably be in a week or two from now. So I think you'll find a lot of really exciting information in that, and a lot of opportunity. However, before we get into the major part of a bull market, if that's what's going to occur, then you've got to expect to see a bit of a pullback before the major wave 3 advance occurs. And that is a much better entry point than where we are right now. Now, there are some competing drivers for gold. I'll just touch on this briefly before we go and look at the gold price. The competing drivers, there's a couple of negative influences. One is that gold shouldn't do well in a deflationary period. And also it obviously shouldn't do well when the US dollar is going up. However, the positives are that gold does well when there's fears about financial stability, and that's certainly what we're getting at the moment, and also negative real interest rates. So they're the positives, and at the moment the positives are winning. They're winning the war against the potential negative drivers. Now, look, what happens in a currency crisis? If citizens chase something that's more tangible than paper currency, And we're seeing that in quite a number of countries. And that's why it's part of the reason why the gold price is going up. And just to underscore that, I've just got the gold price in a couple of different currencies. We'll look at it in US dollars in just a minute, but this is the gold price in euros. So you can see the massive amount of money that's going into gold, and that's gold priced in euros. This is gold priced in the Russian rubles. So obviously, you know that the Russian economy is in trouble. So the gold price has been working its way up substantially since November, and it's gone from around 2,500–3,000 to about 7,800 at this point in time. So an absolutely massive rise in the gold price in Russian rubles. That's because their currency is collapsing. And we're seeing now the same thing in the Canadian dollar as well as others. So absolutely massive moves in those particular currencies. But let's take a look at gold in US dollars. So this is the US dollar value in gold on a weekly basis. You can see that we formed these, we had a triple bottom formation, and then we got a false break, which quite often happens, and particularly when you reach the final part of a bear market. So we had our phase 4 decline, then we've got our phase 1 base, all part of that 3-year bull market, bear market in gold. We get a false break of the lows, which causes a lot of stop loss triggers to be set off, and then the new bull market starts. Now this is not guaranteed, but it's starting to look a pretty robust probability. So you can see we've had a really strong 3-week move in the price of gold, but overall we're still within this phase 1 base. We need to break out to about 1350, and ideally I'd like to see a break above this high here, which is about 1390. So I'd be feeling a lot more positive about gold. Now looked at on a daily basis, this is the daily chart of gold. You can see that this is our first leg up. So this is leg 1. It's advanced from around 1200 to 1300. So there could still be quite a bit more to go on this first leg yet. The best time to buy into gold and gold stocks is when you get that pullback after the first leg higher. So that's what we'll be looking for really the best entry possibilities. Now, just looking quickly at who else has an evolving currency crisis. Well, obviously Russia does, Brazil does. So all of these currency crises, we've got the Swiss National Bank, we've got the euro. There are so many currencies, Japanese yen. There's currency crisis all over the place. So it's no wonder that the price of gold is working its way higher. Now, at this stage, the fear which is driving the price of gold is still country specific. But the worry will become if the fear spreads and traders start to worry about the fact that all currencies might be affected. So at the moment, the US dollar is still the strength, and that will remain the case for the foreseeable future until we see a change. Now, just looking at other commodities quickly, copper has crashed further to $2.49. It really has broken down heavily. So it's joined all the other commodities, iron ore, coal, crude oil, other base metals, and this is a pretty poor sign for the global economy. Crude oil, West Texas Intermediate crude, finding a bit of stability around $46. And as I said last week, the fallout is going to be massive. It's going to be unpredictable, and I don't believe we've even seen the start of the fallout from what's happening in crude oil. So definitely avoid energy stocks for now. Don't try and pick the bottoms. It's just too much risk. There's the spot copper chart. You can see since we broke the support at $3, it's in November, it's been a massive decline. So overall, from a strategy point of view, not much has changed in the last week. The US market remains where it's at. It's the most reliable growth market. But again, only certain sectors of the American market. So biotech, digital technology stocks. So you've really got to get very targeted and very focused. And if you don't know where to go to do that, and don't just take stock picks willy-nilly, then I can certainly help you with that for people who aren't members of Specialist Share Education. Now, as I indicated last week, there are some emerging opportunities in India and Asia, but again, you've got to be careful. You've got to know what you're doing. Don't just go in and buy anything. And of course, gold stocks on retracement are another unfolding opportunity. And as I mentioned, there'll probably be a webinar in a week or two providing a lot more insight into that. So for any non-members who want to know more about investing and trading in the share market and who maybe want some help and support in getting started, there's my email address. Please get in touch with me. That's it for this week. Cheers.